welcome. We might be distracted a little bit because people are still dropping in and we need to let them into the meeting, but let's get started with our webinar today. So thank you for joining us from all different parts of Australia. This is a Curium webinar series. We've been running these for over a year and they seem to be quite popular and quite useful. We try to keep them short, we try to keep them to the point and invite people who can answer different questions that might arise before, after, or even during the webinar. So today, we're going to be speaking about taking a little bit of the regulator lens, and we'll focus on ASIC, but we'll cover other regulators as well. And we'll have a conversation with Yvonne Lamb, who is representing a law firm, Gilchrist, Connell, and we'll focus on some of the more significant things that can happen to your business and how to effectively either avoid them or manage them. Our agenda for today, we'll start with introductions. Then we'll go and see what is the latest in the regulatory landscape. Essentially, what are the regulators focusing on, or what have they told that they're focusing on? Then we'll spend quite a bit of time on item number 3, which is the examples of typical reportable situations and what to do about them. And finally, we'll walk through the tips and tricks, but also practical advice of what to do and how to get ready for regulatory compliance. All right. Your speakers today, those who don't know me yet, so my name's Tatiana. I am the CEO and co-founder of Curium. I'm also director of the board of InsurTech Australia. I used to run claims and operations for Blue Zebra, and I used to do many, many years of management consulting for Marsh McLennan and the Boston Consulting Group. Prior to moving to Australia 7 years ago, I've worked in more than 20 countries for the very, very large global insurers, Asian, European, American, Australian, and so on. And then 3 years ago, I started Curium, and we are a specialist in insurance and claims. We use technology to simplify and make things very, very easy, but we also specialize in actually creating quite a bit of know-how and helping people manage different challenges that come their way. With this, I'll pass on to Yvonne Lamb, please.
Thanks, Tatiana. As Tatiana mentioned, I am a corporate insurance and regulatory lawyer with Gilchrist Connell, and we've been working with Curium and its clients since their launch a few years ago. We do find them to be more informed than others in the industry on regulatory compliance issues. So now on that note, we'll get started on today's session with an overview of ASIC's priorities for the upcoming year for the insurance industry. And all of the topics we'll be discussing today will have a strong theme of consumer protection. So the first topic is product design and distribution obligations, or the DDO regime. ASIC has signalled that it's focused on reducing the risk of harm to consumers of financial products that are caused by poor product design, distribution and marketing, especially by driving compliance with design and distribution obligations. Now, in that vein, ASIC does intend to undertake some targeted risk-based surveillance of the industry to identify and take action against any poorly designed and distributed financial products. And ASIC's already started this work this year with a review of a sample of over 100 target market determinations in the insurance industry across both the life and general industry sectors. And they've provided letters to the industry bodies with their recommended improvements for target market determinations across the board. There will be an express focus by ASIC on low-value insurance products, with a particular focus on home insurance and also life insurance products. It's likely from the target market determinations review that ASIC will then move on to looking at whether insurers and their distributors are taking reasonable steps to distribute their insurance products in a way that is consistent with their target market determinations. Now, the second topic of focus for ASIC is technology risk. And given the increasing level of digitisation in our society, it's no surprise that ASIC has taken an increasing notice of the different threats and opportunities that this has provided. And they're focusing very strongly on cybersecurity. So ASIC has foreshadowed an increase in targeted surveillance of cyber risks and the operational resilience of its regulated entities. And it will be working with industry participants and other regulators, both locally and globally, to keep track of any emerging operational risks, such as AI, and to allow for a whole of government response where it's appropriate. So you might have seen that ASIC's been quite involved in AI regulation and the response to the Australian government on how AI might be regulated into the future. Now, over the next year, ASIC is going to also be reviewing the risks of consumer harm, which flows from the potential misuse of consumer data, algorithms, and also AI in financial services. And they're going to be looking at how regulated entities are seeking to mitigate their risks. And it's been stated by ASIC that entities that have made egregious failures to mitigate the risks of cyber attacks, including any governance failures to ensure cyber resilience, will be subject to enforcement action. Now, in terms of ASIC itself, it's also focused on developing its own capabilities to become a leading digitally enabled and data informed regulator. And that means that ASIC is going to be using data and technology more quickly and accurately to be identifying trends and harms. So it's going to be using technological tools to identify insights in terms of the data that's being provided to it by the regulated entities. Now, on enforcement priorities, as I mentioned earlier, ASIC is going to be taking enforcement action in the DDO space against insurers for low value insurance products. And that's going to be through the use of financial penalties and stop orders. And it's intended that this enforcement action is to encourage insurers and distributors to ensure that their products are fit for purpose, and they will take actions such as issuing stop orders to address the poor product design and distribution of insurance. As we've seen earlier this year, they've taken interim stop order steps against certain general insurers, such as Hollard and Petshaw, for the distribution of pet insurance in June 2023, due to deficiencies that they identified in the target market determinations. Now, over the next 2 years, ASIC is also going to be quite focused on the small business sector. So they will be taking enforcement action against misconduct, which involves unfair contract terms, with a focus on insurance and the credit industry. And so this targeting by ASIC is going to be heightened in terms of the unfair contract terms that might appear in small business contracts. And this is very topical because there's going to be an expansion of the unfair contract terms regime that takes place for insurance contracts that are issued, renewed, or varied from the 9th of November this year onwards. So the broadening of the definition of what constitutes a small business contract will now capture a broader range of small businesses. So previously, the threshold was 20 people in a business that's employed, a small business that employs 20 people. But going forward, it's going to capture small businesses that employ up to 100 people in their organisation. So that's obviously going to be a much larger cohort of small businesses and their contracts that are caught within the regime than compared to when the regime was first rolled out in April 2021 for insurance contracts. Now, last but not least, ASIC is very focused on the protection of financially vulnerable customers. So this is an area that continues to be an enduring enforcement priority for ASIC. ASIC is willing to take enforcement action to protect these financially vulnerable consumers, particularly where there's pricing or claims handling misconduct involved. And within the general insurance sector, they're going to be targeting the home insurance sector. And in addition to these enforcement priorities that ASIC has identified, where there is going to be a current or future review of the DDO regime, it's intended that that process is also going to consider the effect of the DDO regime on vulnerable customers, as well as any design and distribution obligations to specifically protect those consumers. So now I'll pass back to Tatiana to take you through some of the messaging that's coming from the industry bodies.
Thank you, Yvonne. I think I would add that ASIC priorities are very much mirrored within other regulators like APRA. I'm sure the large insurers are already done and dusted with their preparations for the new Privacy Act and also the updated risk and compliance framework requirements that are coming from APRA. Now, from the industry body, so both for brokers and insurers industry, they're different slightly. The focuses are slightly different, and the regulators are signaling, improvement in various aspects of doing business. So for brokers specifically, the broker code went live last year in November. So we've done one cycle of the broker code now, and the message from the previous year was, well, there's still a very serious underreporting problem, both in terms of breaches and complaints. And the message this year is it has improved compared to last year. However, there's still a significant number of brokers who are not reporting anything at all, so zero. And in the eyes of the regulators, no incidents or no breaches or no complaints is a red flag in itself. Now, for insurers, it's slightly different. The insurer code has been live since 2021, the updated one, and we've seen a significant rise in the number of breaches, specifically in claims handling. And as we know, there's a new bigger inquiry going on into the handling of the flood claims in the last 2 years. And I believe personally will actually uncover quite a lot of issues specifically connected to technology, managing things fast, and also following the obligations of timely informing the customers about the progress of claim, but also potentially decisions made in those claims. So the regulators are very active, and I guess the pressure's on. From our perspective, so Yvonne and I have been working together for, well, the last 5 years, I guess, doing different things. What we wanted to share with you today is to say, all right, there are all of these things going on, and sometimes I feel really overwhelmed. There's so many laws, so many things. Tell me what does actually matter, right? So there are things that are small and I can deal with them in my business as usual, but also there are these big things, like kind of the elephants in the room, that can happen. And then how do I know how to spot them? The reason we picked up this topic is we actually, in the previous webinars that we ran, we focused a lot about incidents and how to do the right thing at the beginning. Today, and then we've got a lot of questions because people are actually struggling to understand, how do I know when something happened that this something is actually significant and needs to be dealt with utmost importance and reported to the regulators? That's why we wanted to kind of bring it to the very real examples and to case studies today to show you how to spot a little thing that can become a very big thing in the end. And I guess our main message for today is every business, no matter, as long as you work with people, data, and money, which everybody does, you will have things going wrong. And how we call that? We call that incidents will happen. So the best way for you to manage compliance in general is to actually spot and recognize those incidents early on. And then do a little bit of an assessment test, which Yvonne will walk us through, how to assess those incidents and essentially triage them pretty much if it's going to be a significant situation or not. Now, it's a quick recap. We have shown this example quite a few times already, but it remains very up to date. The question, what is an incident and how to spot one? An incident, a definition of an incident, is a non-typical outcome of a typical action. So imagine you do things as usual. However, what comes out at the end of it is not as usual, is not what you've expected. Very, very typical example, and everybody has done this, is you've sent an email or documents to a wrong person. Sometimes if you've sent many emails or documents, or one document with many names or addresses of people to a wrong person, that is very clear an incident and also a breach of Privacy Act. You forgot to send renewals. So personally, I have not seen a single brokerage, underwriting agency, or insurer who has never breached this regulation. That's typically regulated in the industry codes. Now, it can also become significant and reportable if you've done that, let's say, for many customers, but we'll get back to that, to the theory, how to classify that later. Again, you told a potential customer or a customer, I think you should do something, as a part of general advice without knowing their specific circumstances. Again, forgot to attach an FSG to the customer email. These are all small things, but they should raise a red flag in understanding, okay, something went wrong, and that something needs to go to another person or another department or the manager to kind of assess it further. And final one is realize that the product is not fit for purpose for the customer and did nothing. That's a big red flag. And I guess Yvonne referred to this, that ASIC has already issued a stop order once in the target market determination. All right, so incidents usually happen in areas that deal with customers, data, and money. And examples that should absolutely raise a red flag for you is you can't log into your usual systems. Now, why it's an important? Because that potentially impacts your ability to deliver service as usual. And that, as we'll learn later, is one of the criteria in assessing the situation as being a significant breach. Then your website contains old or inaccurate information or versions of documents. And to be honest, I'm not sure. I didn't do the research maybe in the last 2 months, but I did quite a bit of research on especially broker and maybe smaller insurer underwriting agencies' websites. Quite a few things are still old and not updated with the latest requirements on regulations, or even the versions of the product disclosure statements. You can't, misinform the customer about what you're actually selling. Here, written documentation on a website does not make it clear to the customer what the company does. So, for example, the use of terms independent or impartial, or calling yourself an insurer where you are in fact a broker, is a red flag. You should potentially kind of reconsider the writings on the website. Your staff does not receive adequate amount of and quality of training. Now, I've done many shadowing of different companies, and when you ask the managers, say, what do your staff get, adequate training? Like, yeah, they're all, let's say, GCOP or broker code trained. But then when you actually sit there and then you kind of shadow them and see, what people are doing, they'll be sitting on a breach without knowing it's a breach. Or they'll be sitting on a complaint. They will be going off the phone with the customer and say, oh, this person was whinging about something, but actually it was a complaint that was meant to be recorded. And the root cause for this behavior is a lack of training. Yes, the complaints, we've already said that. The complaints are there, but nobody's recording them. And we have separate trainings and complaints because they don't necessarily need to be directed against your company for you to start recording them. They can be also directed about someone else. But because you're the first person or party who's exposed to this information, it's your duty to record and then, process it accordingly. And finally, as Yvonne was saying, one of ASIC priorities is vulnerable customers. I feel a lot of companies still don't have actually an internal understanding and a process how to deal with them, how to spot them, and how to help them. So all of these are examples of incidents. And now we'll ask Yvonne to walk us through a way to assess them and which are the situations and how does ASIC determine the ones that need to be reported.
Thanks, Tatiana. So as many of you know, since the 1st of October 2021, there's been an enhanced breach reporting regime that's been in place for Australian financial services licensees. And these enhancements were part of the regulatory reforms that came through after the Financial Services Royal Commission. The reform was aimed at remedying inconsistent, inadequate, and delayed reporting of breaches by licensees, because ASIC was finding that on average, it was taking about 150 days from the start of an investigation to the lodgement of a breach report. And some licensees were actually taking on average 4 years to identify incidents that were then later determined to be significant breaches under the old regime. So now the enhanced regime sets out requirements for what it calls reportable situations about core obligations. And these are the ones that are linked to significance tests that we're about to talk through shortly. There's also another category, which is new. It's the additional reportable situations category. And these are not linked to the significance tests, which must be reported to ASIC. Now, ASIC has included a useful diagram in their regulatory guide 78, which we've put onto the slide today, and it does break down those different categories of reportable situations. So the first category, as I mentioned, is the core reportable situation, which arises where you've got a licensee or representative that has breached a core obligation and the breach is significant, or they no longer are able to comply with a core obligation and the breach, if it does occur, would be significant. Alternatively, you might have a licensee or representative that conducts an investigation into whether there is a reportable situation in relation to the breach or likely breach, and that investigation continues for more than 30 calendar days, even if your investigation discloses that there is no reportable situation. So the core obligations we're talking about here are the general obligations of licensees under Section 912A or Section 912B of the Corporations Act. So this is the type of obligation like providing financial services efficiently, honestly, and fairly, and so on. The second category, which is the additional reportable situations category, these were introduced as a set of situations that are not linked to the core obligations or the significance tests. So instead, these additional reportable situations refer to conduct that is considered to be gross negligence, which has been engaged in by the licensee or its representatives, or serious fraud that's been committed by the licensee or representative. So this is obviously the type of conduct that goes towards the licensee or representative's character and their suitability to be providing financial services. So because that sort of conduct, once it falls into that category, is so potentially detrimental to the consumers or small businesses that might be impacted, then ASIC requires that these types of reportable situations are reported to ASIC within 30 calendar days. You don't need to go through the significance tests. You just have to report it to ASIC in that situation if you've identified it. So unhelpfully, there is no statutory definition of what constitutes gross negligence, but there is a definition of serious fraud, which is in Section 9 of the Corporations Act. And it means an offence that involves fraud or dishonesty against an Australian law or any other law that is punishable by imprisonment for life or a maximum period of at least 3 months. Next slide, please.
Yeah, I just wanted to kind of jump in here and say all of this that we're talking today applies to everyone, applies to large insurers, small insurers, underwriting agencies, brokers, and authorized representatives, even though the authorized representatives do not have the core obligations maybe specified in their own right, but it is the responsibility of the AFS license holder to enforce that the authorized representatives are compliant with this regulation. So essentially, nobody's excluded.
That's right, Tatiana. So if we're talking about the first category of reportable situations, there are two separate tests to consider whether a breach of a core obligation is significant. So the first test is a deemed significance test, where you deem a particular breach to be significant if it's an offence under a law that's punishable on conviction by certain periods of imprisonment, if it's a contravention of a civil penalty provision, or if it's a breach of a misleading or deceptive conduct prohibition, or if the breach is likely to result in material loss or damage to a retail or wholesale client. So practically speaking, the effect of this deemed significance test is that if a breach falls into any of those categories relating to a core obligation, then the breach is also reportable to ASIC within that 30 calendar day timeframe once the licensee first knows or is reckless with respect to whether there are reasonable grounds to believe that there is a reportable situation. So it's important to remember that this threshold doesn't require facts or evidence that amounts to certain proof that there has been a breach, only if there's reasonable grounds. Now, even if one of those circumstances under the deemed significance test doesn't apply, you might still have a significant breach under the second significance test, which needs you to consider certain factors such as the number and frequency of similar breaches, whether the impact of the breach affects your licensee's ability to provide financial services which are covered by your license, and the extent to which that breach indicates that you might have some inadequacies within your compliance arrangements that will impact your ability to comply with your obligations. Now, all of these factors do need to be considered by the licensee, and a breach can still be considered to be significant even if only one of those significance factors applies. It might also be significant if you've got a combination of factors. Now, when we translate these significance factors into questions that should be asked by a business when you're assessing whether an incident is reportable to ASIC or not, it turns into a set of questions that we've put up on the slide today. So, did the incident impact multiple customers or just a single customer? Has this incident happened before? And if so, how often and how long ago did this last incident of this type occur? What was done about that type of incident back then? Has it been resolved? Another question you might want to ask is whether the business can operate as usual, or is there a part of your business's service delivery that has been impacted significantly by the incident? So, do you have any issues with your IT systems being down? Now, it's important to consider how the incident happened. Was the root cause due to a human error, which might be something to do with training, or perhaps it's a system error or something else? And lastly, is the incident the result of a single malfunction? Or perhaps is it a symptom of something that's broader and could be a systemic issue within your business that might demonstrate that there's an issue with the adequacy of your business's compliance arrangements? So you might already have this type of incident assessment framework in place within your business. But for those who are already using Curium's platform, I believe that there's an assessment framework that's already built into the platform as well.
Yes.
So now we're going to run through 3 examples of these types of reportable situations for ASIC purposes. The first scenario that we're going to look at is a situation where you've got an insurance licensee that charges an incorrect fee for product X due to a system deficiency. And at that time, the licensee understood that to be an isolated instance based on the facts available. Now, the incident was recorded under this scenario in the licensee's breach register as a breach, but was not assessed to be significant at that time because it only impacted a small number of customers. The system deficiency then was rectified by the licensee in relation to the fee for product X, and the outcome was recorded on the breach register as the resolution for the breach. But 2 months later, the licensee identifies that the same fee charging error is occurring for product Y and also arises from a similar system deficiency. So here we have the identification of the same fee charging error arising from a similar system issue for product Y, which is likely now to lead to an assessment by that licensee that it's a significant breach due to the number and the frequency of similar breaches that are being identified by the licensee. Now, while originally under this scenario, the first time this type of incident happened, it was considered to be isolated and therefore not significant at that time. It was important for the licensee to be recording this incident on its breach register because it assists the licensee to later in the future identify if there are similar incidents happening and to determine whether it might be indicative of a systemic issue and whether that might mean that the licensee's compliance arrangements for complying with its core obligations might not be effective or sufficient. And that in itself is considered to be a significant breach. Now, although there is the similarity between the breaches of the fee charging issue between product X and product Y, and the number and frequency of that is only one of the significance factors for assessment by a licensee, you might still have a breach here that's significant, even if only one of the factors applies. And the greater the number of the similar incidents or the frequency of similar breaches, the higher the likelihood you have a similar breach that is new of a similar nature would be considered to be significant for the regulator's purposes. And the repeat of the breach could be indicative of a continuing underlying system issue that you thought was resolved after the first incident, but perhaps is not actually resolved across the entire system. So here, because the licensee has come to a view that there's reasonable grounds to believe that a reportable situation has arisen because there's been a breach of the core obligation potentially relating to its compliance arrangements or potentially inadequate technological resources, it does need to report this to ASIC within 30 calendar days. And that calendar day reporting period starts on the day that the licensee first knows or is reckless about whether there are reasonable grounds to believe that you've got a reportable situation.
So essentially somebody told you and you haven't recorded it. That's the day when you found out. And if I may just extend a little further. So this example is a particularly big one because if nothing's been done about this specific scenario for a long time, you're looking at a very, very expensive customer remediation program that will be mandated upon you at some point of time. And we will have an expert on this joining us in a month to do a deep dive on these specific programs. But it's important to kind of, for you to understand, the moment there's money involved and there's incorrect charges and it's not the first time, I would say it should raise all the red flags.
Thanks, Tatiana. Now, in our second scenario, this looks at investigation timeframes. So here on the 2nd of July, we have a business division in an insurance licensee that notices a system error that might have resulted in its customers not receiving their insurance renewal documents. As Tatiana mentioned, this is a very common occurrence in a lot of businesses. Now, the incident was logged in the licensee's incident management system on the 3rd of July, and the incident was then escalated to a risk team for preliminary inquiries. So looked at what's the nature of the system issue, when the issue might have started, and how many customers might have been impacted. And this was on the 9th of July. The risk team then escalated the matter to a compliance team on the 16th of July for further review to consider whether there might be any breaches of the law or the General Insurance Code of Practice requirements. And more inquiries were then made about the factual circumstances in relation to which particular insurance products were impacted and whether customers eventually received their renewal documents or not at all. Now, the compliance team then notifies the legal team on the 30th of July of the incident and asks them to conduct an investigation into the breach. The legal team runs through the information that's available to them on the 30th of July. And a week later, on the 7th of August, they decide that there has been a breach of obligations under Section 58 of the Insurance Contracts Act to send out the insurance renewal documents at least 14 days before the expiry date of the relevant policies, and therefore the licensee might have failed to comply with financial services laws. So the difficulty here is that the term investigation is not defined in the legislation. It depends on the size of your business and whether there's actually been any information gathering or human effort applied by the licensee to assess whether a breach has occurred or will occur. So time doesn't necessarily start ticking when you start entering the suspected breach into your risk management system. But it might start ticking from the date that the licensee starts to have its personnel communicating with other staff or representatives who might be involved with the conduct, or they start communicating with potentially affected clients, or when they might seek specialist or technical advice. So under this scenario, when the compliance team commenced its investigation after it was escalated from the risk team, what is considered to be a reportable investigation started arising because they moved beyond the preliminary inquiry stage. And the licensee then is required to report this to ASIC because it continued for more than 30 days by the time the legal team made its assessment that there was a breach and that the insurer might have failed to comply with financial services laws, which is a core obligation under Section 912A of the Corporations Act, and considered it to be significant. It's important to remember that it's also reportable to ASIC if the investigation takes less than 30 days, if at any stage during that time frame you have a determination that a core obligation has been breached and that breach is significant. So it just depends when you reach that particular point. And if it goes over 30 days because you don't have the right systems and processes in place to do the breach escalation and breach assessment, then by default, you might end up having to report it to ASIC, even if you come to a conclusion that there is no reportable situation. And now on that point, even though you don't have to have a breach register under ASIC's requirements, you do need to have this in practice because it is quite a practical tool to have in your arsenal to make sure that you've got potential and actual breaches that are being recorded, and especially to make sure that the status of any investigation, especially the start date of any investigation, is being documented. And this makes it a lot easier for you to calculate when you might be due to report to ASIC or whether you might have gone over that 30 calendar day timeframe already.
Yeah, I would say for larger companies, that's definitely a realistic scenario. For smaller companies, what I've seen is potentially the investigation starts and then people get too busy and then forget about it. And then it's very, very easy to breach the 30 days, even if you didn't do anything for 20, but started, looking into it last month. It is actually a reportable situation. So very real scenario, no matter what size of the organization it is.
Yeah, the more divisions you have within a business, the harder it is to work out where the investigation might be starting. So Yeah, you need to, it doesn't matter which particular team conducts the activities for the investigation. What's important is the type and nature of the activities that's being conducted when you start your investigation. Now, on our third scenario, this is on the additional reportable situations category. And we have here a prospective policyholder applying for an insurance policy using the services of an insurance broker. For this, the insurer requires further documentation to be provided by the prospective policyholder via the broker in order for the insurer to complete the quote and application process for the policy. The insurer makes repeated requests for the documentation to be provided, and at the same time, the policyholder is also separately pressing the broker to confirm with the insurer whether they might need anything else, because there is an upcoming deadline for the insurance cover to be in place for the property proposed to be insured. Now, the insurance broker does acknowledge these requests and is aware of the impending deadline for cover to be in place, but due to their company being short-staffed over a holiday period, the insurance broker fails to take any action to obtain that required documentation from the policyholder, or even to inform them that there's been such requests from the insurer within the time frame. Because the insurer doesn't receive that outstanding documentation from the policyholder in time, the insurance policy is not obtained in the required period, and the property is not insured from the start of the relevant period as required. So, as I mentioned earlier, gross negligence is not a defined term in our legislation, but the failure of the insurance broker under this scenario to act on repeated requests by the insurer for documentation and the failure to respond to the policyholder's repeated contact is considered by ASIC under its regulatory guidance to constitute conduct that is gross negligence. And as I mentioned earlier, any licensee or representative that engages in conduct that constitutes gross negligence is a category of additional reportable situation that needs to be reported to ASIC if it's identified. You don't need to run through the significance factors that we talked through earlier about how frequent or the number of incidents like this that have occurred before. It just needs to be reported as soon as you've identified that it is this type of gross negligence, and does need to be reported to ASIC within 30 calendar days once you've identified it.
Yeah, I'd say it's probably not a very common situation for active business-minded brokers or insurers or anyone, because we just use the broker as an example, but it could be technically anyone. But I'd say an argument from Yvonne about the holiday period or the renewals period is probably a valid one. So it can become a staffing issue rather than, it will result in a conduct problem, but essentially it will be a staffing issue. All right, so what does that mean? Let's just bring it all back together and say, so what? So what do you need to remember when assessing incidents? So first thing, you need to get incidents. So you need to have like a steady pipeline of incidents flowing to you, and you're going through them and assessing them either as a incident only or a breach. Breach means it has broken a law. And then if it's a breach, then okay, how significant is it? So first, you need to have a clear view on the core obligations of your business. Second, is your staff adequately trained? And specifically for anyone holding the license and working with authorized representatives, remember, you bear the inherent risk of them doing the right thing by you. And the more you help them and the more you train them and help them spot these things for you, the safer you are in these terms. What is the current or potential impact on customers? So specifically financials. Like from my practice is there are a lot of things that can go wrong in communications and here and there, but the moment there's money involved, you're most likely looking at a very serious situation / potentially reportable or remediation program at the back of it if you're not doing anything about it fast enough. How many customers got impacted and how fast did you rectify the damage? We didn't really speak about it, but essentially it's not enough just to do the compliance bit. You actually have to jump at it before you do anything else and rectify. Then the current potential impact to other parties. We didn't really speak about them, and in all of this regulatory focus, the regulators are primarily focus at customers, but don't forget, we never work alone. So, and I've seen it very often. Let's say a broker can be impacted by a very large breach by the insurer. And whilst they have not caused it, it's insurer's obligation to inform all of the other parties that they're working with that something happened, specifically in terms of privacy or customer contacts or any kind of financial remediations for clients. Then ability to keep the business open and providing the same service. We're all relying on tech these days, so that's I'll leave it at there. Bad behavior. So what Yvonne was talking about, the gross negligence and fraud and so on. Essentially, bad behavior is a serious red flag. Here, how did the incident occur and who noticed it and how early did people notice it? We train people and we help people to build what's called the first line of defense. And this is essentially what we're talking about here. Do you have a functioning first line of defense? Do your people report things to you? And do they know how to do this? And finally, just make sure that you're tracking the dates. If something is potentially serious going on, just start tracking the dates of when you've done what. Now we are running slightly behind the time, Yvonne, so let's maybe just quickly touch upon what's going on next and essentially the sanctions, the punishment, and then we'll try to wrap up the meeting.
Sounds good. So just very quickly, you may be curious about what ASIC does with all this data it receives about breach reports. And they do publish an annual publication around October every year with high-level insights on the different trends that they've observed with some regulatory expectations arising from that. So they don't name and shame at the moment any specific licensees, but that could change in the future. There will be industry consultation before that happens. But we can take some learnings from last year's first publication, which showed that only 6% of the licensee population lodged a report during the first 9 months of the regime. And this is significantly lower than ASIC expected and suggests that some licensees don't have the processes and systems in place to detect the relevant non-compliance with the core obligations. There's also an interesting statistic which shows that 55% of the reports identified that staff negligence or error is the sole root cause. So this goes back to Tatiana's point that it's very important to ensure that your staff are trained and that you have the processes and systems in place to monitor those on that front line or the first line of defense, because that's usually what goes wrong and what needs to be reported when it turns into a bigger issue. Now, ASIC is going to be releasing their next annual report in the coming month. So we shall see whether they go with the naming and shaming approach or they start providing a bit more granularity in what is reported. And then on penalties, it is important to remember that a failure to report a reportable situation to ASIC is an offence and it can lead to criminal or civil penalties. And in terms of the penalties for AFSL breaches, some of the general conduct obligations in Section 912A of the Corporations Act, such as the obligation to provide financial services efficiently, honestly, and fairly, are civil penalty provisions, and they do have maximum penalties of up to 15.65 million, 3 times the benefit obtained and detriment avoided, or 10% of the annual turnover, which is capped at 782.5 million for body corporates. And this is calculated based on the current value of the Commonwealth penalty units. And aside from these penalties, there are also various administrative actions that ASIC could take against licensees, such as imposing additional license conditions. They can suspend or also cancel a license as well in more serious cases. I might just pass back to Tatiana to wrap up.
Yeah, so just wrapping up, what do you do about it? How do you get ready? Well, first, we've tried to give you a good framework on whenever something's happened, this is what you do with it. These are the questions that you ask yourself. If in doubt, call the lawyer. This is what I do all the time. If it smells, looks like a duck, walks like a duck, then potentially it's a duck. So maybe you should get, a little bit of help to deal with it. What we focus on is start with an incident, try spotting an incident as quickly as possible and see if you can prevent, many more from happening. We do have a couple of, again, very, very general suggestions. So get familiar with your core obligations, provide relatable examples to your people to help them spot an incident, make it easy for people to report an incident. Don't punish them. Don't punish the messenger. If something happened, essentially create a culture. It's good to report one. It's good to have incidents. Then you can deal with them. Have a simple framework for assessing and then identifying breaches, essentially what has broken the law and what hasn't, what can remain under the radar and just stay an incident. Timelines, very important, and there are timelines in different aspects of compliance. Incident is just one of them. Compliance is another one. And finally, get help if needed. I always say better safe than sorry. So if in doubt, I would say self-report, even to the regulator, rather than not report for too long and kind of be found out and spotted. We wanted to leave you with these foundations of what kind of both Yvonne and I have discovered throughout, our practitioner's life. And just before we wrap up, and I'll have a look quickly at the questions if people want to stick around. But essentially, before we formally, finish the talking part of this, if you want, we can help you in different directions, right? To run assessments, to help you set up different things, Yvonne can provide you with very adequate legal advice and essentially take things from the gray area into black and white areas. And also we are running, both of us, kind of industry initiatives. So we're getting a lot of questions during and after these webinars. So what we've decided to do is to start a community where you can actually ask these questions offline, or they're online, and see who's asking what, and essentially share experiences and share different answers. And I'll just speak for Yvonne. I think she and her company run a very interesting update on, regulatory compliance. And that we're definitely sharing in the community, but also I would suggest everybody to, sign up for this. All right, let me just have a look at the Q&A sections. So it seems like, okay, we do have quite a lot in the chat here. I'll walk through them. So will the report for breaches be on ASIC website, Yvonne?
Yes. Yes, it will be. So I think look out for it in the coming month or so. It will definitely be before the end of the year. It will be publicly available, but the level of detail is to be decided in terms of what ASIC will release.
Okay. Will we receive a certificate for this webinar? Yes, this webinar is certified by NZIF. Okay, ASIC's annual report and the breach reporting regime data will be available on ASIC's website likely this month. Yes. What did the bad insurers do to get ASIC to lift the stop orders?
I think they had to work very quickly to amend the deficiencies in the target market determinations. I think it was actually possibly within 24 hours. Yeah. So I think, it's a big stick that ASIC was wielding to make sure that those deficiencies were fixed up straight away so they could get back to distribution.
And I can tell you what happened in other insurers. They all reviewed their TMPs within 24 hours and updated them. So that had quite a big ripple effect through the industry because everyone got very, very busy on the same day. All right, perfect. We're going to wrap up here. We'll send you the certificates. We'll send you the links to join the community to keep on the conversation. Yvonne and I are grateful for your overwhelming participation today. So thank you very much for coming all the way, and we'll see each other at the next webinar. Thank you.
Thanks, everyone.